Let's go. What's up, Mr. Mitchell? What's up,
Hey, how's it?
everyone? We got another exciting episode 13 of our podcast. We also have a brand new name. We're starting some new branding. We are the Business Breakdown Podcast. Exciting stuff. Anyway, today we've got a phenomenal guest who is going to shed some light on a much needed financial topic that's been buzzing around social media for quite a while: life insurance. I'm thrilled to welcome Lazaven Mitchell to the show. Lazaven is the founder and CEO of Prosperity Mindset Financial Group and a certified financial wellness consultant with nearly 2 decades of experience in the financial industry. He's originally from Philadelphia, now empowering communities in Pittsburgh. Also, is doing a lot of work with teens and financial help there as well. It's super exciting. I'm going to ask questions about that. Lazavian's mission is all about elevating individuals and families through comprehensive financial strategies. In today's episode, we are diving deep into the world of life insurance, specifically the difference between term life and index universal life, those good old IUL policies. There's a lot of hype and misinformation about there, especially with IULs being pushed on various platforms, sold under false pretenses. Lazavian's here to clear the air and provide clarity on who should and shouldn't be considered for these types of policies. Before we dive in, a quick word from our sponsors. Finance for Individuals and Businesses began with a vision, a community where like minded individuals could gather and share their passions, experience, and knowledge for a brighter future. Our mission is simple: to foster growth, develop, and keep pushing everyone forward. We believe everyone has the potential to succeed, and we're here to support that journey. Join our community of leaders and visionaries as we grow, learn, and build a brighter future together. For those on YouTube and other platforms, this is originally a Facebook group, and we're going to be keeping it here. Join our Facebook group, facebook.com/group/finance for individuals and businesses. We'll see you there. All right, back to our show. Whether you're just starting to think about life insurance or looking to reassess your current policies, Lazavian's insights are going to be incredibly valuable. We're going to cover the fundamentals, bust some myths, and provide actionable insight and advice that you can use to make informed decisions about your financial future. Lazavian, welcome to the show. We're thrilled to have you here. Let's start with a bit of your journey. What inspired you to focus on financial empowerment? Let's go back a little over 2 decades. What inspired you to get into finance?
Well, thanks first of all for having me, Ryan. It's a pleasure to be here. And to answer your question, I grew up. I'm from Philadelphia originally. I grew up in North Philly specifically, and basically my surroundings and environment. We didn't have access to tools or knowledge, or various just basic information about the way that finance worked, and basically how to grow your net worth. I mean, in school it's so funny, they teach you you know basic math, you can, like, geometry, everything, calculus, but not how to balance a checkbook, or not how to calculate simple interest, or compounding interest over time, or really anything financial. So you know my hunger for financial literacy was really crafted just through those times of, like, wondering, how do people become wealthy, or how do people move through the progression in society in terms of their socioeconomic status. And that curiosity led me to you know want to know more about it and pursue a career in business. And I didn't necessarily know that I wanted to be a financial advisor, but I did know that I wanted to be a business owner, and I wanted to, basically kind of figure out the code, or crack the code, or strategy around how to, you know, achieve upward mobility in society in the best way possible.
Right. Did you have like a mentor or someone that pushed you in that direction as well? Did someone kind of talk about it here and there and that kind of got piqued your interest, or you saw a movie, saw a video, heard someone talking about it?
Well, when I was younger, fortunately, I, was raised in the church and I was around a lot of older people. And one of the things that, I didn't necessarily have one specific mentor, but it was like bits and pieces of things that I would pick up from various folks that would kind of, you know, have me think a certain way. So I would, wonder about, certain career choices or certain decisions, or like, there would be a lot of people who went to my church who were older. They had businesses and things. And, I would just like talk to them about that, or like, what do you do? And, how do you go about, getting onto that career path? And so it was kind of like having my gears turn, at that age.
Yeah, yeah. It it definitely, there's a lot of curiosity that happens whenever you're in those teenage years. And that's a huge, formidable part of your, your future, everything that you're learning, everything that you're doing. So whenever you're interacting with older folks, at the church, talking about finances and stuff like that, whenever you're not even old enough to buy stock, I mean, it's cool. It's cool. I did something similar. I used to do a bunch of paper trading on, Market Watch way, way back in the day before I could buy stock or do any kind of trading. Um,
Awesome.
so that's definitely cool. And I got into it because, my dad was always into finance. He's also older. He's like, he had me whenever he was 44, 46, something like that. So, it was just kind of always on the TV, CNBC, something like that, listening to Kramer, sell, 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 buy, 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 all that good stuff.
Right.
But yeah, it's definitely, people pick it up, uh, get inspired, learn differently. But everyone has their own little journey in their financial world because everyone's completely different. And that's kind of one of the reasons why we're definitely chatting, because life insurance is be created a craze, um, with a lot of platforms, honestly. And I think that people are trying to make shorter and shorter reels, leaving more and more information out, just telling you the stuff that they want you to hear, kind of just like a lot of other, sales and marketing is. But, obviously, borderline unethical, sometimes illegal. But what is some of the things that you've seen that is definitely illegal to be doing on social media?
Well, there. How much time do you have? So essentially, there are a lot of posts and advertisements that are, depicting IULs in a certain light or comparing them to certain investment products online. A lot of the times, you see advertisements that'll say, hey, get an IUL, or you'll see it compared to like a 401k or a Roth IRA, and then you'll have like the advantages and the disadvantages. Um, Many of those posts are disingenuous. And so, to kind of give you some perspective and background about how all this works. So, on the life insurance side, right? So, you have various products. And then on the investment side, you have various products, and they're both regulated differently. So anybody who is registered as an advisor with FINRA, or the SEC, it's a different standard of regulation. So there's a lot of things that you're not allowed to do, and there's ways that you're not allowed to represent products. And so on the life insurance side, however, there's rules in place, but the enforcement of those rules, it's state to state. It's not standardized the way it is with, FINRA. And as a result, you get a lot of people getting away with a lot of these claims and attracting customers unethically. And so, there's a lot of misinformation around the concept of indexed universal life, otherwise known as IULs. Most people who are agents are advertising it to be this kind of replacement for actual investments or retirement accounts, and that's just simply not the case.
Yeah. Um, Seeing it advertised as an investment and um, just to kind of put it straight forth, low income people who haven't even started a Roth or even a individual 401k, it's definitely not always the best route. And it's just, yeah, there's definitely a lot of ethics involved there. With IULs and term, there's definitely a market for both. We're not saying that IULs are the worst thing on the planet. We're not saying that term is the worst thing on the planet. And I mean, there's pros and cons to everything here. With term, you're going to have some benefits that IULs don't have. And then with IULs, you're going to have some benefits that term doesn't have. And it's not just those two options that you have for to put your money in a vehicle. I mean, there's a lot of other options, but comparing these, how would you kind of categorize maybe term or IULs? How would you almost bucketize or categorize um, possible participants in these vehicles?
Yeah, so it all starts off at, I'm going to go back to, uh, you know, financial advising 101, so to speak. And
Hmm.
that is, there is no cut and dry, one size fits all answer, right? It depends on the client's specific circumstances, right? So it depends on their goals. It depends on their risk tolerance. It depends on their time horizon. It depends on the assets and, how they're looking to protect them. Because let's break it down fundamentally. What is life insurance? Life insurance is a transfer of risk, right? And so just think about any type of insurance that you would seek to buy. So, home and auto, right? We have to buy auto insurance, it's the law. And so, what is that? It's protection in case of an accident, right? You're transferring the risk from yourself financially to the insurer. And so that is what insurance is meant to do. Now, somewhere along the way, marketing departments got really sophisticated at saying, "Hey, let's kind of experiment with some things and get some other types of products going so we can attract a different audience."
Hmm.
Right? And so now
Grab more
we
market share
have
for sure.
exactly. So now we have insurance products that have savings components. And while those policies are certainly useful for a lot of different scenarios, they are not for everyone. And again, financial advising 101, it depends on the specific client. It depends on what their needs are, their goals, objectives, and their profile is going to be, because, you know, there is no cookie cutter answer to what type of life insurance should I be looking at. But what
Right.
I've done is I've basically looked at it over, years and years of doing this and said, okay, there may not necessarily be a one size fits all approach, but there certainly is a hierarchy of accounts that you should, kind of look at getting and, thinking about, hey, okay, a checklist, if you will, of accounts that maybe I should have depending on what my circumstances are. Right.
Do you
And
have a
so,
checklist of those?
yeah, I can give it, I can rattle it off to you.
Yeah, yeah. I mean, either rattle it off or we can also post it to the chat when we get off here.
Yeah, absolutely.
Keep going, you're good.
So yeah, but you have to ask yourself, what is my goal, right? So if your goal is purely, protection, what am I protecting when I buy life insurance? And you're protecting your source of income, your life, right? Because think of it this way: when you pass away, let's say you're married, right? And you're a homeowner and you've got kids and, you've got bills, student loans, responsibilities, all of those types of things, right? If you pass away, when you go into the ground, your income stops, right? So if you're a two income household, and you're depending on both of those, salaries or incomes being there, if one of them suddenly disappears, the first question you got to ask yourself is, how important is your income to the household? Right? So if you remove one of those incomes, what happens to the household? They're going to have a challenge, right? So, maybe we have to sell the house. Maybe we have to downsize. Maybe we have to get rid of our standard of living changes dramatically.
Yeah.
And we haven't even talked about burial cost and, homegoing services and all of those types of things, right? So, and you can't call the mortgage company and say, my spouse passed away. Are you able to waive my mortgage payments for 6 months? They're going to look at you like you're crazy,
Yeah.
right? So the risk of losing an income for your household would be catastrophic for most people, especially since statistically half of Americans can't afford to cover a $600 emergency. So imagine losing an entire household income. So when we're talking about transferring risks, that's the risk you're transferring to the insurance company for your premium dollar. And most people just look at insurance as just, I just have to pay for a funeral. No, insurance is life insurance is much, much more than that. And the difference between, life insurance and maybe home and auto insurance is that, hey, it's legally think about this. It's legally mandated for you to have auto insurance, right? Well, Ryan, let me ask you, is it guaranteed that you're ever going to get into a car accident?
Nope.
Right? So, but is it guaranteed that you're going to pass away someday?
Death is always guaranteed.
Only two things in life: death and
Yeah.
taxes. Right? So
Right.
think of it like you're protecting yourself against something is 100% going to happen. And let me ask you this other question: do you know the date of your death?
I wouldn't even want to know the day of my death.
Like, normally people don't wake up and say, "Oh my gosh, I'm going to die today. Let me call and buy some life insurance." It doesn't ever happen that way, right? Most people are comfortable living their lives, working their job, live the daily grind, and day in, day out. Days turn to weeks, weeks turn to months, months turn to years. And before you know it, something happens, you get caught off guard, boom, somebody's gone, income gone, family devastated, and we have a GoFundMe page, right? And so,
man, I hate seeing GoFundMe pages.
yeah,
It's that stuff is super sad, man. That stuff is super sad because it's not even like the health insurance piece, it's also the life insurance piece.
yeah, and it's avoidable too. And the younger you purchase life insurance, or I should say invest in life insurance, the better off you'll be because the cheaper it is. And that's the thing too. Like, people need to understand, when you're supposed to buy life insurance early on in life. The earlier on you buy it, the less expensive it is, right? Because think of it this way: if you were trying to insure a car that was, brand new, it's more expensive, right? Because it's fresh, and the repairs would cost more. But humans, it's different, right? We get more expensive as we get older, right? Because it's, healthcare costs more. Our bodies we're more closer to passing away or expiring the older we are. And so from an actuary standpoint, actuary science is basically the math that determines how much your policy is going to be based on your demographics and your health and background and all of those types of things. So, the average lifespan in America is about 82 years old. So, if they determine, hey, you're going to live X amount of time, and then you wait until you're like 65, 70 years old to buy insurance, well, then your insurance premiums are going to be much higher than they would have been if you would have got them into your 30s. But the problem is, Ryan, that most people don't take financial literacy and responsibility and things that you kind of need to be doing seriously until they get into their 50s, because that's when you're kind of looking around at, other people and what they're doing, and oh, how come they have this and that, and where'd they get this and that, and maybe I should be thinking about, maybe you're up, one night and you're seeing a Colonial Penn commercial or something, right? And you're like seeing all these things and you're like, maybe I should get some of that stuff, but you've waited, right? You've waited so long to do it. Now it's going to
Yeah.
be more expensive to start. And that's not even including the implications of what that means for the investment side, right? If you're saving for retirement, right? Because money is worth more today than it'll be worth tomorrow. So when you procrastinate on investing and saving for retirement, you're losing money too. So, and again, most people don't take that stuff seriously until you're in your 50s. And then it's like, okay, if I want to retire at 65 or 70, I don't have that long to start. So now I have to save and invest more to get to the same goal that I could have achieved if I would have started, 15, 20 years ago.
Yeah, it definitely gets much, much harder as time goes on, especially because that's the lifestyle that you kind of grew into your 50s or 60s, or however long it took you, or even into your 70s. And then you end up working at Dollar General for your, quote unquote retirement, just for some extra cash in the door. It's just, I've heard a lot of these cases before. I'm definitely familiar with it. I don't do the life insurance policies that you do, but I definitely talk to a lot of life insurance people and hear kind of what's going on out there. And obviously, it's all over my feed because it's just part of the industry that I'm in. But it's definitely a lot of it's there's a lot of intricacies in life insurance, especially if you're just starting out, because there's different levels of life insurance as well. And I know you talked about kind of the levels of risk that you have, or the tier. You want to cover that real quick?
Yeah. So if you're young, and this is basically general information by age group, I would say. So, and by, financial background. So if you're a younger, professional who is, making close to six figures or more, and, you're in your late 20s, early 30s, there's kind of like a hierarchy of accounts that you should consider, going ahead and setting up for yourself. And, one of those, depending on if you're married or not, is going to determine certain nuances of this. But
Right.
in general, a Roth IRA is definitely something that you should have and establish as early as you can. And every year, the contribution on those goes up by $500 approximately, right? So this year, the maximum contribution to a Roth IRA is $7,000 for the 2024 tax year. So what that
Is
means
there
is,
you said it's up 500 every year,
yeah. So last year it was 6,500,
right?
and
And
this year
then,
is 7,000, and in 2025 it'll be 7,500.
is there a time when that number is going to cap off?
No, not unless Congress fails to, keep up legislation around it, or something changes, or there's a tweak legislatively. But for the most part, Roth IRAs are, protected under the law, and they were created originally so that people could basically retire tax free.
Right.
And it's the
Right.
really only pure investment vehicle. So this is where we talk about the difference between life insurance and
Can you
investments,
explain a
actual
Roth?
investments.
Can you explain a Roth real quick?
Yeah, so it's a vehicle that allows you to put $7,000 of after tax money away into that account. So I want you to think of a Roth IRA as a bucket, right? A bucket that gets preferential tax treatment. That's what it is. So
Yep.
inside that bucket, you can have many different types of investments, stocks, bonds, mutual funds, ETFs, all of those types of things, right? But whatever you choose to invest in to grow your money inside of a Roth IRA, that money grows tax free. So when you go to take that money out, when you turn 59 and a half years old, all of that money is tax free.
What if
So,
you take it out before there's a penalty? Does it vary by state, or is it 10, 20%?
so IRAs are governed by federal law. So
So
it doesn't
that
matter
makes
what state you live in.
right.
The rules apply across the board the same. There is a early withdrawal penalty. However, the unique uh, distinguishing factor between a traditional IRA and a Roth IRA is that with a traditional IRA, it's pre-tax money. So the government is going to want their, taxes at some point. So there's what's called a required minimum distribution, which means you have to take some money, start taking distributions by, 59 and a half. So
Right.
with a Roth IRA, there is no required minimum distribution because the government's not going to get any tax money. So they don't care when you could take your distributions. You could start taking them in your 80s. It doesn't matter. So the piece is that, to answer your question, with a traditional IRA, there are penalties for taking out the money. Obviously, both it's 10%, but there's a law that passed 2 years ago, the Secure Act 2.0, that makes it that you can access money from retirement accounts for an expanded list of reasons, right? Without penalty. One
What
of
are a
those
couple of those
reasons,
reasons?
one of those reasons is to purchase a first-time home purchase. So the government wants to incentivize people owning home ownership. And one of the ways they've done that is they said, hey, look, if you take $10,000 out of your retirement savings to put down as a down payment, up to $10,000 rather, we're not going to penalize you that 10%.
Right.
And, there's other reasons, and including now the provision just went into effect for 401ks that you can actually, if you are the victim of a domestic abuse situation, you can take money out of your 401k to relocate and to cover costs associated with that. So there's been an expansion in the reasons that you can access money early in your retirement accounts without penalty. But the cool thing about a Roth that's different than the traditional IRA or even a 401k is that after 5 years of having the account open, you can access the principal without any penalties.
Damn.
That's huge.
How can you leverage that the most?
So let's say, and I'm not a proponent of breaking into retirement accounts early because statistically, 70% or 7 cents out of 70 cents on every dollar that gets invested into retirement accounts gets eaten up and taken out before it's time to withdraw the actual retirement. So essentially, people are, you ever hear that expression, robbing Peter to pay Paul?
Yep.
Well, in this scenario, most Americans are Peter and Paul. So you're stealing from yourself. You're just your future self, right? Because most people never put that money back over time. And so what ends up happening is, you might think it's 10,000 today and 20,000 in today's dollars. But if you compound that over, 20, 30 years, you're looking at 2, 3, 400,000 potentially, depending on how high inflation is. So,
For sure.
but most people don't know to look at it that way. So they just think of it as, hey, I need my roof fixed, or I need a new car, or I need, whatever emergency situation. And this is why what I do for my clients, I set up an emergency fund, and we figure out a way to get that funded, because here's the other problem: credit card debt. When we're over $1 trillion in credit card debt, and because life is going to happen
now, right?
Yeah. Your car's going to break down. You're going to need some new shingles. Your hot water tank is going to go. whatever, life happens to a lot of us, right? And so what is the first thing that people do when life happens? They reach for their credit cards. And financing a today repair and paying for that, 5-10 years from now doesn't make any sense, right? Especially with interest rates given where they are now. I mean, it's an endless cycle. If you pay the minimum payment, you'll never get out of debt. You're just
Right.
a hamster on a wheel. So to avoid
You're
that,
the
you want
perfect
to,
customer.
yeah. So you want to establish an emergency fund so that you have, basically 6 to 12 months of your annual income saved up in an emergency fund, where if you do experience an emergency, which at some point you will, right, you can leverage that account and use it instead of using up your credit cards and getting further and further into debt, right? Because that's a important piece of wealth building, is getting out of debt, because a lot of people can't invest. They can't save. Why? Because they're in debt. So if we can help you, get out of debt, you focus on building wealth, focus on protection, because it's all about transfer of risk, and it's all about protection, right? What
Right.
are we trying to protect when you are, young and you're working and you're accumulating assets and you're in that phase where loss of income would be devastating, right? That's where life insurance comes in, because we're protecting that source of income. We're protecting your life, right? What are we trying to protect when we invest to be able to retire and maintain our standard of living? We're trying to protect our money from being eroded by inflation, right?
Right.
Because if inflation steals the value of your money every day, and your money needs protection from inflation. That's what investing is for, right? Because when you invest your money, the market, depending on what instruments you use, the market will outpace inflation. And so that's one of the things you're trying to protect. So in all cases, it's all about risk management. It's all about making sure that you're protected against two outcomes. Either you're going to live too long or you're going to die too soon. One of those things is going to happen.
And
And you
death
have to
is
have both of those
guaranteed.
bases covered. Yes.
Man, man. Yeah, and everyone's completely different, and everyone's goals are different. We haven't even talked about like a 529 or anything like that. Um, with I kind of want to do the inverse for IULs. What makes the IUL appropriate?
So IUL is for someone who has basically maxed out and has all the rest of their financial vehicles pretty much already set up. They probably have a Roth IRA on them. They probably have a Roth IRA on their wife. They probably already have some other form of life insurance, be it, term or permanent insurance. They probably have a, health savings account and, a 529 for their kids. And,
Right.
they already have an emergency fund. They already have all of these things set up. And so they still have money left over after all of those things. And when you do, or, they could be a business owner that is looking to, compensate or add compensation to their highly compensated employees, or, the owners of the business or partners, or however your firm is constructed. So, usually high net worth individuals, high income earners who can afford to utilize those policies for very specific reasons in a very specific time frame, because it's important to structure those policies correctly so that they don't lapse. The problem is most of the policies that do get sold, IULs, they're not structured properly. And so what ends up happening is the fees and the cost of insurance ends up cannibalizing the policy. And you get this letter in the mail from the insurance company, 30 years later saying, hey, 20, 30 years later saying, hey, by the way, your policy is going to lapse if you don't start paying $2,500 a month. And by the way, your cash value is gone because we had to use it to keep your policy in force for these past 20, 30 years. And, it's sad because there's so many people that have that same experience, because their policies they were basically geared towards higher coverage amounts, which generate higher premium, which makes the financial salesperson who sold them to you a higher commission.
Right.
So, everybody's gone at that point, right? They done sold that policy to you, 15, 20, 30 years ago. So they're probably, who knows where they are now. And you have to deal with the fact that not only have you lost your income protection, so if your policy lapses, there's no payout. You've also lost hundreds of thousands of dollars potentially in, whatever was put into the savings component of that policy. And that's the danger of IULs, really, is that if they're not structured properly, they're like a ticking time bomb. And you really have to know what you're doing, and you really have to know what specifically you are looking to accomplish when you get one of these policies.
Right.
And so, yes, when you hear the term tax-free, or with these policies, because they tend to get sold as a tax shelter a lot of times, and that's true, but only to a point. And there's only two reasons why that is. Number one is you can borrow against your money. Okay, so
can you explain that? Because that be your own bank is pushed.
Yeah. So the be your own bank kind of theory is that, rather than having a financial institution or a lending institution lend you money and make interest off of it, you can loan money to yourself. Here's why that's kind of a misnomer, because when you borrow money from the bank is loaning you money with the intention of making a profit, right? Because they charge you interest. So when you borrow money from yourself, do you charge yourself interest? And when you borrow money from an IUL, more specifically, the interest that you paid on the money you borrow, who gets that money? You or the insurance company? So if it's the insurance company to answer the question, but if you know what I mean? So it's not really being your own bank, right? And by the way, all borrowed money is tax-free. I don't know if you know this, but when you went to go borrow money to go buy a home, did they charge you any taxes on that money? No, they don't. You don't ever pay. That's why wealthy people borrow rather than sell their stock and take the capital gains hit. They borrow against their portfolio because the interest on the money is lower than the taxes they would pay. It's just arbitrage, right?
Right.
So it's the same thing with IULs. It's not tax-free inherently. It's tax-free because you're borrowing against your own money, which you could do anywhere. And in some cases, you could do better and pay less interest. But that's another conversation. But here's the other reason why it's considered tax-free, because after a while, let's say you've overfunded the policy. That's how they describe it in the industry, is overfunding. Think about how that sounds. Overfund. Why do I have to pay more to get the benefits of what I'm initially trying to get? It's like you're overpaying, and you are, because you have to, in order for the policy to not lapse or implode, you have to overfund it. I mean, I don't know. I mean, it was a genius move for them to create these policies, but when you really think about how they work, it's like, I don't know if people want to do that. But when you overfund the policy, for 20, 30 years, you can get your money back. When you turn, 59 and a half, you can start taking money out tax-free. But it's the money you've put in all these years.
Right.
You know what I mean? And then there's an insurance corridor where you can't ever put into the policy more than what the death benefit is, so at any given time. So if you have a $150,000 death benefit, you can't have you can't put in $250,000 of cash value. So the more money you put in, the higher your insurance coverage has to be to make up for that difference, which makes your cost of insurance go up. And by the way, in an IUL, it's annual renewable term with a savings account. And that's what makes it so toxic, because annual renewable term goes up every single year based on your attained age or the age you're at now. Right. So think about it this way. If I get sold an IUL and I'm 40, I'm going to pay the 40-year-old premium, and at 40, at 41, my premium is going to go up. And then this is why it implodes, because over time, the premiums keep going up and up and up, and you don't notice it because the money that comes out of your bank account every month is the same amount. And this is the sinister part. You don't ever notice that your cost of insurance is going up, because the difference, you're not paying the difference. The difference is coming from your cash value. And that's why if you don't overfund it, it's much like a credit card. We talked about credit cards earlier. You can choose to pay the minimum payment, right? But if you pay the minimum payment, what happens? It's the same thing with IULs. IULs were designed to be flexible premium, right? Because you can kind of choose, your premium within a certain range. Like, oh, I don't have the money this month, so, maybe I'll just pay this month, pay this much. But the problem with doing that is if you don't overfund it, what happens? Your policy lapses over time.
I do have a quick question from a comment. I'm sure this might even need like a personal question, but is it better to put more percentage for 401k or Roth? My employer is matching 5% in 401k, or can I do same percentage, 5 to 10% for both?
Well, it depends on your situation and how much you have saved and what your goal is for retirement. When do you want to retire by? And what do you want your standard of living to look like when you retire? So I would say in general, because I don't know what your specific circumstances are, but what I would say is that in general, what I would do is contribute up to the employer match, right? Because here's the problem with 401ks at work. And this is so frustrating, and I'm going to try to make it simple. As a financial advisor, I am not allowed to tell people what investment instruments inside their 401k to put their money in. If we were to sit down in any other context, if we were to sit down and create a health savings account or a 529 or a Roth, I could easily tell you, recommend whatever. But the Department of Labor does not allow financial advisors to tell clients where to put their money inside of a 401k. I don't understand it. But essentially they say that, fun fact. If you're registered with FINRA, Advisory School 101, you are not allowed to tell clients how to put money into their 401ks at work. Because even though essentially it's a liability issue, which is weird, because wouldn't it still be a liability issue if I'm recommending SPY or, VOOO to my client? Right. But it's the department. Look at the Department of Labor. They made the rule. We just have to abide by it. But my point is this. Most people pick the default option in a 401k that they're offered at work. And that default option may not necessarily be the best option or the best performing option, right? Because most people don't know how to pick the options in their 401k. They just get presented with this list and they just be like, okay, let me pick X, Y, and Z, but they don't know if it's good or not. And I can't tell them if it's good or not, which is totally crazy, right? But that's why you only invest up to whatever your employee's contribution limit is. You take the rest of that money and then you go max a IRA if you can, depending on which tax bracket you're in and what you care about more. If you care about a $7,000 tax deduction, then you would invest in a traditional IRA. If you care about having your money tax-free in retirement, then you go set up a Roth IRA and try to get as close as you can to the max. If you're married, you can do a spousal IRA. So now instead of $7,000 a year, you're investing $14,000 a year. Now imagine how much quicker you could retire if you contributed to your 401k at work to the employer match, and then had $14,000 outside of work that you were setting aside every year too, right? So it's all about getting free sooner, right? It's all about, optimizing your retirement and making sure that you can maintain your standard of living.
Right. Yeah, it's not as cut and dry as it sounds.
No.
And so with this financial group that I run, I see a lot of people that ask questions, and some questions are very detailed and some are pretty general. But what it really comes down to is some questions need a more personable answer and some are not as personal, it's more general. Um, that is pretty close to being a personal question.
Yeah.
But yeah, no, it's just gathering more information. I mean, you talked about it earlier. It's the same in almost any regulated industry, but you have to, assess everything before you really make a strong recommendation.
And that's
Um,
where that's where we go wrong with IULs, is that there is no qualification process. It's just marketed to general audience. So if I am a single parent seeing the ad for IULs, and I'm like, woo, yeah, and I'm making $45,000 a year, and I'm like, oh yeah, IULs. Like, no, that's not what you want to be doing right now, right? You want to find the most efficient and cost effective way to do anything that you're going to do financially, right? So you got to ask yourself, is opening an IUL the most cost effective way for me to transfer risk from myself to an insurance company? And that's where term comes in, because term is the most cost effective way to do that, because it's like any other, it's like life, like home and auto insurance. You get protected for a term. If you don't get into an accident in that term, you don't get any money back. No bells and whistles. It's just pure protection. You either get to an accident or you don't. You either die or you don't. So, there are term products that are now, basically having a little bit of bells and whistles in terms of, return of premium and all of those types of things, but they overcharge you to be able to afford to do that, because you got to think about it. How can they afford to do some of the things that they're doing? Right. So when you talk about return of premium, you're talking about overcharging someone a little bit every month for 20 years. And then at the end, giving them back, a little bit of their premium. So you would be better served to take that overcharge that they were going to overcharge you and invest it yourself. And you could come out way more than just having, $10,000, $15,000 back after 20, 30 years. Right. So when you're talking about term, dollar for dollar, it's 7 to 10 times less expensive for the same amount of coverage versus IUL. So while, yeah, there's no savings account attached to it, you don't have to deal with any of the rigmarole that happens with your policy collapsing before you need it. It's there, right? And when we talked about earlier, protecting you in case you live too long or died too soon, guess what? Term actually fulfills that need, because let's take a 30-year-old who is in entering the prime of their work career, who's married with children. If I get a 35-year level term benefit for $1 million, and I have a Roth IRA and all of these investments going on separate, right? You separate your insurance from your investments. Guess what? During the 30, 40s of my life, I'm protected in case I die too soon. My family gets $1 million. I haven't built up the next egg yet, saving, but I was on my way. Now, let's say I don't die and I get to my 50s and 60s on the other side, the downside of the term policy. I've accumulated, $2-3 million. So guess what? I don't need the life insurance anymore, unless I want to use it for estate planning tools. But the point is, if you remember, this is all about transferring risk.
Right.
Why do we have to transfer risk, Ryan? Because we can't afford to take the risk on ourselves. If you could afford to take the risk on yourself, you wouldn't need insurance. Think about it. If you had $5-10 million in the bank, what do you need auto insurance for? If you get into an auto accident, what's 15-20 grand? You know what I mean? Like I think that's the part that gets missing with insurance, is that the only reason why you need it is because you're transferring risk, because you don't have the money to cover the damages or the peril of that risk. So with life insurance, after the 30-year term is over, right? We've invested all these years, we've taken the advice, and now we've have $2-3 million in our investments. So now we don't need the insurance. And one of the things you could choose to do is you can keep insurance on you for estate planning purposes. And certainly if you wanted to leave an inheritance for your kids, it's the most cost-effective way to do that, right? How many of us wish that our parents would have left us $1 million? If you could leave your kids $1 million tax-free, why? And that's the other thing. Life insurance benefits are tax-free.
Tax-free.
You could leave your kids and your family $1 million tax-free. And if you set a plan like that, a 30-40 year term up in your 30s, that would be like $100 a month, if that, depending on how healthy you are. Because obviously, the more healthy you are, the cheaper it is too. If you don't smoke or take a lot of medications and those other caveats. But the point is, if you do something like that in your 30s, you're set.
Right.
Now, if you wait to buy $1 million policy in your 40s and 50s, now you're talking to 150, 200 a month. But still, I mean, 200 a month to make sure your family has $1 million after you die. I don't know. I think that's a good investment. And not to mention, life insurance is an asset. A lot of people don't know this, but you can use your life insurance as collateral for a loan.
Right.
It's called collateral assignment.
Yeah. It's similar to Keyman Business Insurance.
Yeah. Life insurance. Yeah. And even like you just brought up, Keyman Business Insurance, right? If I'm a business owner that has an important employee who, without that employee, we'd be lost, and they pass away, what am I supposed to do? How do I go out and replace that person or the revenue of loss that I experience with losing them? If the company takes out an insurance policy on them and they pass away, I have a little breathing room. Now I don't have to panic, right?
Yep.
Same thing with buy-sell agreements in a partnership, in an LLC. If me and you are 50-50 partners in a business venture and I die, my share of the business can fall into hostile hands. Like, what if it goes to my wife or my aunt or my cousin and they come in and say, all right, Ryan, it's a new day around here. We're going to change XYZ and you're not doing this. No, we're not having this no more. This podcast is now going to be called, whatever, it's something Inc., Acme Inc. or whatever, right? You wouldn't be too happy about that, would you?
No, not at all.
No, absolutely
it's a good old hostile takeover.
Yeah, exactly. So instead of having to go through that, you can use insurance swaps to make sure that the business, you can buy me out in the event of an untimely death.
Right. Yeah, it's pretty well known in the investment business industry, because usually a lot of investors take out Keyman Business Insurance for the CEO or the founder that they're investing in, especially if it's a pretty large amount and they depend on it. I think Bezos had a pretty expensive Keyman Business Insurance for quite some time. I don't even know the amount, but I bet it was nuts.
Yeah, and the premium on that, right? Now imagine a agent that would have loved to write that as an IUL. Jesus Christ. I don't even want to think about what those premiums would be.
Man.
I mean, you're probably talking millions.
Yeah. Yeah. For sure. Yeah. It's been an interesting kind of journey to learn more and more about life insurance. Obviously, I don't know everything about life insurance, but
Yeah.
kind
And
of
it's not
wrapping my
exactly the
head.
sexiest topic either.
Oh yeah, yeah, no, and everybody hates insurance. If it says insurance, people hate it.
Yeah,
I'm
that's one
very
of the reasons I had to get all these other licenses.
right, right. What are your other licenses that you're carrying right now?
So I have a Series 65, I have a Series 6, 63. I have my mortgage license. I could do home and auto. Pretty much Swiss Army knife when it comes to financial services. You probably need like 5 or 6 people to do all the things I can do personally.
Right. And that's under the Prosperity Mindset Financial Group. Is that what all those are
Yes.
under? Kind of like that's
Yes.
the
Well,
parent
they're
company?
registered to, they're my personal licenses, but I established the company with those
Right,
licenses.
right, right.
Yeah.
Cool. How'd you come up with the name Prosperity Mindset?
I was thinking about what I wanted my business to, the culture of the business to be, and what I wanted it to convey to people, and what the core value system of what I'm bringing to the table to be. Because in the early years of my career, I would sit with people and it would be a lot of a hesitancy with making certain moves. And I'm like, okay, what is the root cause of that? Right? Like it's a lot of things that prevent us from being successful in life seem to be around our mindset and the way we view things. And so my view was, if we could make that change in the mindset of people to help them understand that the decisions they're making today, even if they don't see the immediate gratification from that, are going to pay off down the road. And what is the combination of all of this work that we're putting in and what we're trying to get people to see and experience? And that is prosperity.
Right.
So, in the mind, because everything has to happen here before it happens anywhere else. So if you don't change your mindset around how you see money, how you experience money, what you think of money, right? Most people think of money as just, oh, this thing I just go to work for and they give me this check and I pay my bills because I have to eat and I have to live somewhere, right? And but it's so much, money is a tool to build, right? Think of money as soldiers that are in your army and their job is to go out and bring you back more money.
Right.
That's the way you should look at money. That's the way wealthy people look at money, because they know how to deploy capital, right? So that's knowing the difference between assets and liabilities. Most people spend their money on liabilities, things that depreciate over time and don't bring them anything but a bill, right?
Those are the
So
consumers
changing
right
your
there.
perspective is that prosperity, to the prosperity mindset of changing the way you see your money. Because if you change your way you see your money, you're like, oh my gosh, this is amazing. Now, instead of like impulse buys when you go to the store, you treat investing as an impulse buy. Like, oh my God, I got a bonus to work at work today. Let me go, invest, and let me go pick up some, mutual funds or stock or whatever your preferred vehicle is, right? That's actually what happened to me. Like, and I
Yeah.
love when the market goes down because it's going on sale.
Yeah.
You know what I mean? You know how many people made so much money during COVID? Because I used to trade options too, Ryan. I don't know if I told you this or not, but I used to trade options. And on occasion I still do. And so it's an excellent way. Like, if you know what you're doing and you have the mindset and the willingness to learn, you can be surprised some of the things that you can do. But that's basically where that name comes from. It's prosperity mindset.
Yeah, for sure. It's awesome. That's awesome. Yeah, I remember you being an options trader. Our original conversation, we even had talks about this episode just being about options. I just think options has always been super interesting. I was introduced to it in my mid-teens. I'm not like a guru or anything. Not at the level you are, but it's there's definitely a lot there and a really heap of opportunity, a lot of opportunity there, especially if you know how to do it.
Oh man.
Because once you understand and see how money moves, you can do things with options. Um,
Yeah.
it's
Like right now, there's a huge play on Nvidia, right?
Oh
It
yeah,
was at the 20. It came down like 8% yesterday, and it's going to hit some crucial levels at 106. That's a huge buy zone. So I'm going to be making some plays off of that too myself. Not financial advice, everyone. Don't you know?
yeah. Don't
But
follow this.
uh, yeah,
This
but
is not
I'm
recommended.
yeah, personal trade of mine that I'm looking at is Nvidia off, a bounce off of, the 20 MA on the weekly charts.
Yeah, yeah. It's been interesting seeing Nvidia become the highest appraised company in the world
Hmm.
now. They surpassed Microsoft.
Yeah. And
How many?
that's their journey is their rise. It's just crazy. I mean, I think Kathy Woods had some Nvidia that she sold out of a few years ago, and that position probably cost her like billions of dollars. It was something crazy like that.
Yeah,
But you never know, and it's not predictable. Even with the GameStop stuff and AMC, it's just, and people get caught up in, it's like the lottery, right? It's the reason why people play the lottery, because it's that dopamine hit that you get on possibly being rich overnight and what that means. And you
right.
fantasize about driving the Lambo and going down the South Beach and getting 100-foot fishing charter. It's like, but the thing about it is, if you don't know how to manage your money, that's not going to last long anyway. Because that's why most entertainers and sports athletes, things like that, they go broke because they go and they create a lifestyle that they can't maintain when the money stops coming in, because that doesn't last forever. And when you get chunks of money at a time, people just live like, oh, like time goes by so fast. I mean, COVID has been like how many years ago now?
Yeah,
Like, you
4.
know, exactly. Like that's nuts. We're about to have another election. Like listen, I'm telling you. And this is why I have to impress upon the audience that the most important asset you have is time,
Yeah.
because you can't get time back.
It's
You
not
can
being
you
created
can
anymore. Same
Yeah,
with land.
you don't. Yeah, yeah, exactly. You can waste your time, you can spend your time, or you can invest your time.
Waste, spend, invest.
Hmm.
Waste, spend, or invest. That can be the podcast name, podcast episode name. Your choice.
Exactly.
That's good,
Because
man. That's awesome. Well, man, I know we just passed the hour, but I definitely appreciate having you on. There's definitely a lot to unpack here for all the listeners. If you listen live or you're listening later, um, we are going to have Lazavian's info in the comments, also his contact information, website, and all of his business information. So if you have any questions, just to talk to him or talk to him about his business, you can definitely reach out. Lazavian, you want to plug yourself?
yes, you can reach me, prosperitymindset.com. You can go, book an appointment. I'll have a address link to my calendar also. So you can just book a consultation. I do free consultations. I don't charge anything for that. And I'm licensed in 17 states. Most of the states where this broadcast is going out in, I'm going to be able to do, help clients in those states. So definitely.
Yeah, for sure. We talked about the demographics of who the podcast is and where everyone's located. So I think it's a really good fit. If you haven't talked to Lazavian, definitely reach out to him. He's definitely pretty smart individual, but also pretty cool to talk to. Very easygoing. I think this is our third conversation, and we're able to go back and forth, talk about whatever, and kind of build on ideas and create strategies. It's always cool. It's always cool to see. Um, Lazavian, always a pleasure.
Yes, sir. Yes, sir. Thank you, Ryan. It was so great to be here, and thank you for having me.
Awesome. I appreciate it, sir. Talk to you later.
Take care.